Office towers are still standing. The lights are still on. The financial system has not collapsed. From the outside, the commercial real estate market looks much as it always has. But beneath the surface, a slow structural reset is unfolding. This chart shows two metrics that typically move together but are currently diverging. Over the last few months, office vacancy rates across major U.S. cities have remained near multi-year highs. Yet, as you can see by this flat line, systemic financial failure metrics haven't spiked. We haven't seen a wave of banks failing. That divergence is temporary. A massive wave of commercial real estate debt is rapidly approaching mandatory refinancing windows. The bulk of these loans will mature through 2026 and 2027, forcing property owners to negotiate new terms with higher interest rates. Commercial real estate is a business of leverage. The value of a property is derived from expected future cash flow, the structure of its debt, and a specific set of economic assumptions. And many of the assumptions that supported the sector for more than a decade no longer hold. Because no major institutions have imploded, it is tempting to conclude the worst is over. But the lack of a sudden crash is exactly what masks a creeping systemic threat. In a traditional financial crisis, problems appear suddenly. Panic sets in, assets are rapidly liquidated, asset prices collapse, and losses become instantly visible. Commercial real estate today is behaving differently. Instead of rapid liquidation, the sector is experiencing a delayed adjustment. Property owners and lenders are doing everything in their power to avoid forced sales. Owners are extending their loans. They are negotiating refinancing timelines and offering rent concessions to keep buildings nominally occupied. Simultaneously, banks are managing their exposures carefully, choosing to extend timelines rather than aggressively marking down asset values. To the general public, this creates a convincing appearance of stability. The buildings are open, the property management firms are functioning, and the loans haven't officially defaulted. But stability and resolution are not the same thing. Projecting stability merely defers the math. Unresolved structural uncertainty warps economic incentives throughout the system. To understand the nature of this pressure, we have to look inside the balance sheet of a standard commercial office building. Commercial buildings use significant leverage. Owners depend on rental income to cover operating costs and debt. Pre-2022, financing $100 million at 3% left a substantial margin of free cash flow. But refinancing that exact loan near 7% completely consumes the cash flow gap. The building itself has not changed physically. The tenants are exactly the same, but the economics of ownership have deteriorated. A severe jump in the cost of capital can render an asset non-viable, even if the tenant roster remains unchanged. Now add the reality of modern occupancy pressures. Office utilization remains below pre-pandemic norms. Companies have adapted by reducing their office footprints, formalizing hybrid work models, and delaying expansion plans. Suppose historic 95% occupancy falls to 75%. The baseline rental income drops sharply. To retain tenants, owners offer rent concessions, compressing revenue further. This creates a squeeze effect, falling revenues at the exact moment debt rollover costs skyrocket, compounding pressures from both sides. Commercial real estate stress is a mathematical mismatch between old property valuations and new financing realities. If these properties are under financial strain, the logical expectation is that prices should collapse and the market should clear. Yet, transaction volumes remain subdued compared to pre-2022 averages. This happens because property owners are behaviorally anchored to older prices. They resist selling at lower valuations, holding out hope that pricing will eventually recover. Buyers demand discounts reflecting the 7% financing reality, but sellers refuse to meet them. Because buyers and sellers cannot agree on valuation, the bid-ask spread widens. The market stops functioning, transaction volumes flatline, and instead of immediate repricing, the market enters a deep freeze. While a frozen market prevents a rapid crash in property values, it traps the financial ecosystem in a state of deferred reality. And that delay has consequences for the banking sector. Regional and mid-sized banks are deeply connected to local business lending, regional development, and credit availability across the country. These specific institutions hold significant exposure to commercial real estate debt portfolios. If commercial property values decline, these banks face pressure on their loan books. But banks do not need to wait for actual defaults to become cautious. Even the possibility of future real estate losses alters their behavior. Management teams become defensive. Recent lending surveys indicate that smaller banks are reacting to their commercial property exposure by broadly tightening their lending standards and raising collateral requirements. When banks preemptively choke off capital, they act as an invisible contagion. They take localized stress in the commercial property sector and spread it directly into a systemic tightening of credit conditions. When banks tighten underwriting due to commercial real estate exposure, a healthy business seeking a $500,000 expansion loan faces higher barriers. Lacking capital, they delay hiring. Fewer jobs suppress aggregate income growth, which directly reduces consumer spending, pulling dollars out of the local community. So a problem that began with office buildings transmits into the broader economy. This is why commercial real estate matters far beyond real estate. Unrelated businesses and households ultimately face tighter credit conditions. Commercial real estate is deeply interconnected with local economies through municipal finance. Commercial property taxes serve as a major revenue source for urban districts. If office valuations decline over time, city revenues weaken. Municipal finance data already points to weaker property tax growth in major cities. Lower revenues force municipalities to restrict budgets, affecting the capacity to fund public services, maintain transit infrastructure, and invest in urban development. This is the third macro-to-micro bridge. The devaluation of private real estate exerts indirect, but cumulative pressure on public living standards and civic vitality. Market participants are still waiting for a return to older office demand patterns, but the longer hybrid work persists, the more businesses adapt. Long-term demand assumptions no longer match the pre-2022 data, rendering old valuations difficult to justify. There are now two realistic paths forward. If financing conditions ease and office utilization stabilizes, the system may absorb the adjustment over time. Under Path A, valuations reset gradually, banks manage their exposures smoothly, and cities adapt to evolving commercial patterns. But if interest rates remain elevated, the 2026 and 2027 refinancing cliff will intensify the pressure. Under Path B, the market's delay tactics are overwhelmed, forcing valuation stress, credit tightening, and a slowdown that spreads into broader economic activity. The absence of a collapse does not mean the absence of stress. Financial systems do not always break through sudden panic. Sometimes they weaken through slow repricing, delayed recognition, and prolonged uncertainty. And those slow-moving pressures can reshape credit, cities, and economic behavior before a crisis officially begins.